File with your CPA, max your 401k, run payroll, rinse and repeat. That's the playbook most business owners at your level are running. And it's not wrong, it's just incomplete. In 28 years, the most consistent thing I see at income levels of $1 million plus isn't bad decisions. It's missed conversations. There is one in particular strategy that comes to mind that has been available for decades, but almost never gets brought up. Not by CPAs, not by many advisors. There's a structural reason for that. And I'm going to show you exactly why that happens and walk you through the strategy itself so you can understand it and decide if you can benefit from it. There's one section in this video where I break down exactly who this applies to and who it doesn't apply to. That's the section we're staying for. And at the end, I'm gonna give you a yes or no checklist. If you get to the end of that checklist and something doesn't feel quite right, reach out to me directly. Let's get into it. Your CPA files your taxes, but who's actually planning them? When did you last have a proactive tax conversation with your CPA? Before the year ended, not in April, not when the return was due, but before December 31st, while there was still time to do something in the calendar year about it. For most business owners at this level, the real answer is it hasn't happened. Not because you haven't wanted it to, but because the way most CPA engagements work, that conversation isn't part of what you're paying them for. The job you've hired them to do is to file accurately, to report what happened, to make sure the numbers are right, and the return goes out on time. That's tax preparation. Tax planning is something different. It's the work that happens before the year closes. That decision about how to structure your income, your compensation, your retirement contributions, the ones that actually change the numbers on the return before it's set. Once December 31st passes, those decisions are locked. There's nothing to plan. There's only what to report. Let's take a consulting firm owner doing around 1.2 million annually. Good CPA, 8 years with the same firm, files on time every year. From the outside, everything looks fine. But if that owner sat down with someone whose job was to look at the whole picture, not just a return, but the compensation structure, the retirement plan, the entity setup before the year close, there's a real chance a planning strategy would surface that has been available for years and never come up. Not because the CPA did anything wrong, but because that kind of review was never part of what the CPA was asked to do. That's the gap. Your CPA is very likely doing exactly the job you hired them to do. The question is whether that job covers everything your financial picture actually needs. So here's why that strategy almost never gets brought up. It comes down to how each professional's job is actually defined. Your CPA's workflow is organized around compliance, filing the return accurately and on time. The proactive work that requires coordinating with a financial planner, hitting implementation deadlines, and managing an ongoing plan design, that sits outside the scope of most standard CPA engagements. Not because CPAs are incapable of doing it, because it's not what most owners have ever asked them to do. Your financial advisors face the same boundary from the other side. A strategy requiring real fluency in business income structures and IRS qualified plan rules may simply not be part of their regular practice, especially if their client base is broad. So what happens? The strategy that required both professionals to coordinate go unimplemented, not because they're unavailable, but because nobody is watching for them. This isn't failure of either professional, it's a coordination gap. And the strategies that require two disciplines to work together are exactly the ones that most consistently fall through. That's the structural reason. And it's been costing business owners at your level for a long time. If this has you thinking and you have questions that are better for a conversation than a comment, there's a link below to set up a 20-minute chat. Let's keep going, because now I want to show you one specific strategy that lives inside that gap. Here's exactly what it is and how it works. The strategy is a cash balance plan, a type of IRS qualified defined benefit plan used alongside a 401k. Most owners maxing a 401k assume that's a ceiling. It's not. Your 401k allows you to contribute roughly $72,000 per year into tax-deferred retirement accounts. That's including the employer contributions. IRS limits adjust periodically, so you want to confirm figures with your CPA and your plan administrator. But for a business owner in their 40s or 50s who might be generating $1 million or more in revenue, $72,000 annually tax-deferred contributions may not move your tax picture much, at least not the way you want it or need it to. A cash balance plan is actuarially determined, meaning the annual contribution limits is calculated specifically for you based on your age, your income, and your defined retirement benefit target. Because of that, the contribution ceiling is significantly higher. Now, depending on your age and your income level, a combined 401k and cash balance structure can support contributions of $200,000, $250,000 or more per year. Now, they're subject to IRS limits and plan designs, which your CPA, your plan administrator, and of course your financial advisor need to confirm for your specific situation. But I can tell you, I've got clients who are contributing $390,000 or more inside of this same structure I'm talking to you about. Every dollar contributed is a dollar that doesn't appear as taxable income in that year. Now, this is a qualified retirement plan under ERISA guidelines, IRS sanctioned, required professional setups, an enrolled actuary, a third-party administrator, annual filings. It's legitimate and worth finding out if it applies to you. So let me give you a hypothetical example to make this concrete. Let's say you're putting away $72,000 a year, maxing the 401k, feeling good about it. Now let's say a coordinated plan design opens up $200,000 in total annual contributions instead. That's $128,000 more per year going into tax deferred rather than being paid out as taxable income. At a hypothetical 5% average annual growth rate, this is for illustration purposes, actual returns will vary, but let's use 5%. $72,000 compounding annually over 20 years grows to roughly $2.5 million. The same assumptions applied to $200,000 annually gets you to roughly $6.6 million. The difference in that picture isn't the rate of return, it's how much was going in. That's not a projection for your situation. It's a way of seeing how much the contribution level matters. Independent of anything the market does, what's actually available to you depends entirely on your age, your income, your entity structure, and an analysis run on your specific numbers. This is just an illustration to give you an idea of how this works, and every situation is going to be different and have different results. The important thing to consider, if you've been maxing your 401k and assuming that's the ceiling, it may not be. The ceiling is going to depend on your plan design. Most business owners have never had anyone actually look at what's available to them. So let's take a look at the qualification breakdown. As you're watching and running mental math, here's what actually determines whether this is worth exploring for your specific situation. This structure tends to make mathematical sense for business owners with net income in the $400,000 to $500,000 plus range after reasonable compensation. Below that level, the cost of the plan administration, the actuarial work starts to eat into the benefit in ways that change the math. Above it, the benefit typically scales with income. S Corp, C Corp partnerships and LLCs that have elected appropriate tax treatments are the structures most commonly associated with these types of plans. Sole proprietors and single member LLCs taxed as sole proprietors may still qualify, but the plan design differs. Your CPA needs to weigh in on this for your specific structure before anything else can happen. This is the factor that surprises owners the most. If you have significant W-2 employee base, the cost of funding contributions for eligible employees can substantially alter the economics. For solo owners, single member practices, or small partnerships, the math often looks very different than for a business owner with 25 or 30 staff members. The same thing applies to income consistency. This plan requires annual funding commitments, so variable revenue businesses need a plan design that accounts for that specifically. An actuarial analysis runs both of those factors for your actual situation. Cash balance contribution limits are higher for older owners. The models calculate what's needed to reach a defined retirement benefit from your current age. A 52-year-old can contribute significantly more per year than a 38-year-old at the same income level. If you're in your mid-40s or older and haven't looked at this, the window where the math tends to be most favorable is now, not later. And here's where the math tends to break down. Businesses with high W-2 employee counts relative to owner income, businesses with highly variable revenue, and businesses in early growth stages where capital is better deployed back into operations. And if those describe your situation, this specific structure may not be the right entry point, though there are likely other planning areas worth examining. Not every strategy fits every owner, and most owners assume this applies to someone at a higher income level or different structure than they might have, or someone who's further along than they are. The threshold is actually lower than you think. The question isn't whether you're big enough, it's whether anyone has actually run your numbers for you. And that brings me to the timing issue, because this strategy has real deadlines. You're running a business, nobody is coordinating things and writing you about deadlines, so weeks turn into months months, months turn into years. It happens, but there's a real cost to overlooking this, and that cost compounds the longer it sits. Remember the numbers from chapter 3? Now think about what happens if you hear about this. Say you'll look into it and 2 years pass. Those 2 years of that extra 128,000, the difference between what you were putting in and what a coordinated plan could have supported, compounded over the remaining 18 years of that window, represents over $600,000 in opportunity cost that doesn't come back. Now that's just a hypothetical based on the scenario that I ran, but that's $600,000 for delaying that you can't make up for. That's what 2 years of inaction looks like at this contribution level. And this strategy does have a hard deadline. The plan has to be established before December 31st of the tax year you want that deduction. And that's not a sales tactic. That's just how the structure works. That gap between knowing about a strategy and having someone actually implement it, that's the work I do. I'm a business owner. I'm a certified financial planner. Our planning is built around quarterly sprints focused on 3 core pillars: cash, protection, and investments, which is what defines our name, Tribox. We're not CPAs. We're not attorneys, but we make sure those relationships are coordinated. So your CPA, your attorney, your financial plan are all working from the same picture at the same time. And for a strategy like this one, that coordination is the entire difference between implementing and not. And the question I have for you, has anyone on your advisory team ever brought up a cash balance plan or a defined benefit plan? The one sentence I want you to take from this video is you may not have a tax problem. You may have a coordination problem. And that gap might be worth solving before 2026 ends. Before I let you go, here's the checklist I promised you. Make sure you take a screenshot of it. And if you're wondering whether a cash balance plan makes sense for you, or you're just not confident about your current tax picture, there's a link below to set up a 20-minute chat. I'm here to help whether it makes sense for us to talk or work together or not. I enjoy these conversations. And if this has opened your eyes to one strategy you didn't know existed, there are more sitting right behind it. Click the video here. I'll break down 7 of the most commonly missed tax strategies for business owners in 2026. Thanks for watching, and I'll see you next week.